We recently came across an article on alternative investments which certainly sparked our curiosity. Of course, the highlight of the article were the 11 to 13% returns that these products were targeting, which is far better than the 5 to 7% that we make on traditional debt products. Now, alternative investments are of many types. There are hedge funds, private equity, commodities like agricultural produce, energy and metals. Then there is real estate, venture capital, private debt placement, peer-to-peer lending, investing in startups, arts and antiques, vintage coins, stamps, what else? There is invoice discounting, inventory financing, and many more such unknown but usually effective investing plays. In addition to the higher returns, most alternative investments are not linked to the stock markets or even the bond markets, which then acts as an asset hedge and can be used by investors to diversify one's portfolio. Additionally, many investors, especially HNIs, family offices, and also some rich retirees, use these instruments to generate passive and recurring income. And so in this video, we shall explore 4 such alternative investment types. We shall examine these in terms of how they work, the returns they offer, some risks that they carry, and over time, we'll try to cover a lot more of such instruments on this YouTube channel. Let's begin. If one studies how a bank works, you will notice that the concept of P2P lending is nothing new. After all, individuals deposit money in a bank against which they earn interest, and the same money is lent out to some other individuals who pay an interest to the bank. Now, in a traditional setup, it's the bank that keeps this difference between interest paid and interest earned, and it also puts in many rules, terms, conditions, and guardrails on which who can borrow, how much can be borrowed, what interest can be paid, etc. Modern P2P lending programs have been built by removing banks from the equation, which means depositors or lenders in this context can earn more interest on their money, and likewise, more borrowers can get access to finance with customized approval procedures. In essence, P2P lending platforms like Faircent, Lendbox, LiquiLoans, RupeeCircle, etc. act more as facilitators and risk mitigators. In the process, they provide a range of facilities which include onboarding, credit evaluation, agreement signing, disbursement of loans, and collection services. Individual lenders can now select borrowers per their preferred loan criteria, their location, the profile that they require, reasons for taking a loan tenure, which is typically between 3 to 36 months, and their desired rate of interest, which ranges from 12 to 35%. Understandably, lending money to anyone is never risk-free, and there is always that chance of the borrower defaulting. In fact, while researching for this video, I spoke to a relative whose experience with a P2P lending platform had given very mixed results. While he had good success the first time when he invested via the P2P platform, his second innings was less than satisfactory, with 2 of the 15 borrowers he lent to defaulting. So while he did not lose any money, the returns he clocked in the second tranche were just about 3%. Nevertheless, if you are keen on exploring this avenue, please ensure you research the platform for the credit checks and the third-party data points that they employ. Also, never go blindly by the interest rates on offer. Assess the borrower's profile carefully before giving the loan. Check with friends and colleagues on their P2P lending experience. Always lend to multiple borrowers rather than just one so that the risks can get spread out. And most importantly, start with smaller sums of money to see if this instrument really suits you or not. The fact remains that everyone expects the P2P lending industry to only rise from here, with regulations making their operations a lot more transparent and with the government continually promoting cashless technologies and financial inclusion. Traditionally, investing in real estate requires capital ranging from a few lakhs to a few crores. But now platforms like Strata, PropShare, etc. have made it possible for retail investors to own commercial real estate in smaller proportions. So here's how this works. The business model starts off with the fractional ownership platform identifying an investable grade A property like a commercial building or a warehouse. Of course, the properties that are identified almost always has an existing tenant who has been locked on a long-term contract which helps with cash flow visibility. Now, since the price of owning such a property would run into a few crores, the platform invites investors to pull in capital to finance the acquisition of the asset. This commitment for retail investors start at 10 or 20 lakhs each, post which the platform creates an SPV, a special purpose vehicle, to acquire the property, and the investor becomes a shareholder in this company. Fractional ownership startups generally charge an annual asset management fee of about 1%, and they also take in a share of the profits over a particular hurdle rate. From an investor's perspective, like any real estate, the owner receives a monthly rental income which comes with built-in rent escalations. Additionally, the investor also benefits from the price appreciation that these properties have over the years. So in numbers, the fractional ownership platforms claim to be offering rental yields of 8 to 9%, which is significantly higher than the 2 to 6% yields that traditional real estates offer. Plus, when we factor in the appreciation in the property's values, these deals seem to be targeting a pre-tax IRR of 12 to 15% over a 5-year period. So in many ways, fractional ownership works like a real estate investment trust. However, fractional ownership is not regulated, while REITs are SEBI-monitored and have stricter conditions regarding diversification of assets and distribution of gains. Other than lack of regulations, fractional real estate ownership is exposed to regular real estate risks like lease renewals, occupancy challenges, etc. Having said this, this is a growing field and there is increasing interest in this alternative investment approach. For the last 2 years, fixed deposit investors have been a grieving lot, with every return struggling to match the inflation rate. But now we are seeing a boom in startups offering bonds, structured debt, and other high-yielding fixed income instruments to retail investors as they look to make a dent in the $1.5 trillion fixed deposit market. One of these weapons of FD destruction are high-yielding debt instruments, which, in addition to offering higher interest rates, also allows investors to put in amounts as low as 10,000 rupees. Platforms like Vint Wealth, BondsCart, Altify, etc. offer products like government bonds, AAA rated papers from lending institutions, high-yielding BBB rated corporate bonds, private bond placements, and also structured debt. This means the retail investor can choose from a host of products, yields, credit protections, liquidity, and complexity, a lot of which was only available to high net worth individuals in the past. Of course, I must point out that a lot of these are sophisticated products, and while choice is a good thing, some offerings can get a bit tricky if people continue to base their investing decisions purely on the yields offered. For instance, some platforms offer a product that is referred to as senior secured bonds. So there are two words here, senior and secured. The term senior means that these bondholders enjoy a first priority in terms of repayment of principal and interest in case the lending institution defaults. This is obviously good for the lender. Further, the term secured means that these bonds are backed by some kind of collateral like a pool of personal loans, gold loans, vehicle loans, etc., which is another layer of protection. So this way, even if the platform offers a BBB rated bond, these senior and secured provisions help in somewhat improving the creditworthiness of this product and therefore the attractiveness of these bonds. For example, Vint Wealth is a platform in this space that has recently closed a 25 crore issue of BBB plus rated senior secured bonds issued by Quadrillion Finance. This offering came at a pre-tax IRR of 11.5% for a bond tenure of 1 year, and as protections, these unlisted bonds were issued against a collateral of personal loans to salaried individuals. The payment itself was structured in a way that 33% of the principal would be repaid every 4 months along with the interest for the period. Of course, this doesn't mean that the bond issuer won't default, but some protections plus a delicious yield, which typically ranges from 9 to 12%, does tilt the scales in the investor's favor. There is usually a time lag between a vendor supplying goods or services and he getting paid for it. Now, to better manage cash flows during this period, vendors typically approach a bank or a financial institution who then purchases these receivables at a discount for upfront cash. Today, several platforms like CredX, Giraffe, TradeCred, etc. have skipped the banking connection and match vendors and investors who are keen to participate in this financial opportunity. Now, invoices can run into lakhs and even crores, which is why these platforms break up an invoice into manageable parts, allowing investors to buy a fraction of the unpaid invoice amount. The minimum investment amount changes from deal to deal, but we do see transactions starting from 50,000 rupees in some cases. These opportunities typically run for a short tenure of 30 to 90 days, and the pre-tax IRR can be as high as 15%. From a risk perspective, it all comes down to the credibility of the entity that will be making the payment to the vendor, which effectively is now the investor who has bought a fraction of the invoice. If the paying entity fails to pay or delays the payment, or if there are delivery issues or legal troubles, then it can severely hamper your returns and even the receivability of your principal. Of course, on its part, the platforms offering this service do their best to verify the authenticity of the raised invoice, the payment history of the entity. They seek post-dated checks and might even ask for a personal guarantee from the promoter. Most of the alternate investments we've discussed in this video have been around for many years, but were not really accessible to retail investors like you and me. But with ticket sizes getting fractionalized, we expect a lot more interest developing in such alternative products, and some of them even becoming mainstream in the future. Now, while most of these alternative investments are pitched as a higher return alternative to fixed deposits, one should also look at them as important diversification tools that bear little correlation with traditional asset classes like equities, bonds, and golds. In this video, we also saw how some seemingly simple products are being given additional wrappers of credit protection and security, which is all aimed at improving the risk-adjusted returns of these instruments. And while this works in larger parts, one should always be aware of the risks that these products carry. For instance, most of these platforms and structures have a short track record and might not have been stress tested enough. Secondly, there is the ever-present credit risk, especially when one is involved in lower-rated papers and when a solution needs the cooperation of multiple parties. Thirdly, there is a liquidity concern, as there is no active secondary market to sell your alternative investments. And finally, most alternative investments lack regulatory supervision, which can be a big problem when things go wrong. So these are some risks that investors should consider, and which is why, in our opinion, one should not consider these as replacements for your bank fixed deposits or debt mutual funds. But yes, some instruments do show a promise, and if you are keen on dipping your toes in these waters, then it is recommended that you limit your exposure to not more than 10% of your fixed income portfolio. And with this, we come to the end of this video. I sincerely hope this video gave you some starting insights on alternative investment products like P2P lending, fractional real estate, high-yielding bonds, and invoice discounting. For more information on the same, do visit the websites of these platforms, and do back that up by reading news reports and reviews on these products. Once again, thank you for your time. Do subscribe to our channel. Do like this video, and I look forward to catching up with you next week on another insightful topic. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.